Howdy, Jacob here. Today we're looking at Chuy's holdings in the hotels, restaurants, and leisure industry. 640 million market cap on 583 million enterprise value. They are a Tex-Mex restaurant founded in 1982 out of Austin, Texas. Growth for the business has been fairly impressive. Return on invested capital, however, has fallen quite a bit from their 2017 levels. And it looks like that's because there was huge operating margin declines. But even still, 7%, not terrible. On the operating margin side or gross margin side, mid 40s, operating margin, mid single digits. Income statement shows a decrease in shares the last couple years. So up from 10 years ago, but down consistently the last 3 years or so. Balance sheet has 68 million cash on hand. No short-term debt, no long-term debt, just capital leases for their restaurants. And so that is a very positive sign. That's a safe investment from a balance sheet perspective as long as they consistently make money. And from a cash flow side, the last time they didn't make money was 2017. Ever since then, they've made positive free cash flow. Their capital expenditures are fairly large in comparison to their cash from operations. So there's not a hefty production of free cash flow, but their use of cash is really just reinvestment in share repurchases. So I think we can make some assumptions already on the revenue growth side with all the stores that have yet to be placed down. I mean, I could easily see it grow 7% a year. I think, right around market average is what I'd say. I think that they'd still have room to grow at the end of 7 years. I don't think they'll have expanded everywhere quite yet. But it is a pretty competitive business. I mean, if you want Tex-Mex, if you're in the mood for that, obviously Chuy's can be a great get. But sometimes you're just in the mood for authentic Mexican restaurants or all other types, Chinese food, burgers, whatever. And so I think that competition is really going to be tough. I'd probably put it into my margin of safety, but if I were to truly want to invest in it. But for now, I think I'm comfortable with these. For margin, as far as margins go, let's do 5 and 4% with share repurchases of 1% is about, let's round up 7 million. And so offset stock-based compensation, 11 million. I think I'm good with that. So with my assumptions, I'm saying the company's stock price needs to fall 70% before you get the return I'm looking for here. I mean, I guess not a huge surprise with what I'm seeing. The 20 on the PE side with the highest margins, or one of the highest margins ever, and then the discount rate well above the growth rate. So I'm not terribly surprised by it, but I think the business is fine. I don't think it necessarily has a moat or anything. Like, I don't think it's necessarily a Starbucks or something that people can't live without. And so that's why I think there's going to be some challenges here. But for me, there's just not enough margin of safety to be entirely comfortable to invest in. But I hope you enjoy the video and have a great rest of your day. Thank you.